So we've looked at fundamentals that drive the market, the economy, different policies, different factors. Oh, you know what? Let's adjust this. Hello. Let's get this right. Let's make sure we get this right. How about that? A little bit larger. There we go. All right, so we've looked at fundamentals. Now let's look at multiples. All right. So once you project the fundamentals, you have to select reasonable, realistic multiples to use to value companies, stocks, and the overall market. Commonly used multiples include price to earnings per share, price to revenues or sales per share, price to EBITDA per share, price to free cash flow per share. If you are valuing a private business, typically you look at price to free EBITDA or price to free cash flow, price to book value per share. So these are the multiples that are commonly used by investors. Okay? You can easily find historical multiples for the S&P 500 and for other indexes. So there's a lot of information out there about prices and about multiples, about fundamentals as well. All right, so let's take a look at some of these charts. So here we have the S&P 500 price to sales ratio, and so you can see how it's tracked going back into the early 90s, where it was around 1 times sales, jumped all the way up to 2.5 times sales back in late 1999. This was the influence of the technology sector on the overall market. So if you're buying up here, if you're invested up here, then that's a very scary time, very high relative to where the market typically is. And then we had the market correction of 2000, 2001, 2002, and multiples came down. So this slide here is the average, which is about 1.5 times over the long term, 1.5 times, the sales of 1.5 times. So sales, a price of sales of 2.5 times, you have no business being in the market up here, folks. Sorry. But when you're up there, you're thinking it's going to go even higher. You see this line do this, and you're thinking it's going to go even higher. Well, it flattens out here, and then starts to go down in a big way. All right, then it traded pretty flat through most of the 2000s. This is the Clinton years, and then here's the Bush years right here, in through here. So the Clinton years up and down, and then we had the Bush years, okay? And then we had the financial crisis at the end of the Bush years and the Obama years. So Obama comes in 2008 toward the bottom, okay? This wasn't his fault. This was not Obama's fault, all this right here, okay? And then we climb back out. We've had a long bull market run, okay? I'm going to have to update this chart because it stops in 2014 to see. Let's bring that, we'll have to bring that forward. So here we are. This is the price to book value ratio. And again, it did not move nearly as large in such a major way, but going into the 2000 correction, but once again, you can see where it was very, very high. Then it came down, and it stayed pretty low ever since. It dropped, it bottomed again in 2008, then started coming back out, and we're back around historical norms here, 2000, and this goes through 2016. Okay, and here's the S&P 500 PE ratio going way, way back, and so you can see that somewhere between 10 and 15 for many, many decades, you know, it seems like 13, 14, 15 was kind of the average, and then interest rates dropped, and once interest rates dropped, then we had the market really take off. And once again, this is here we go, We spiked in 2000, then we spiked again in 2008. And the reason why the P ratio got really high in 2008 isn't because the market was high, it was because earnings disappeared. Okay? And then they bottomed out around 2009 and then started coming back out. And so we're trading now at around, this is the 24 range, but we're a little bit lower than that now, but we're still much higher than we were historically. Let's take a look at why. Okay, it all has to do with interest rates. Let's look at some of these variables. So what this is a chart of the balance sheet of the Federal Reserve. And the balance sheet of the Federal Reserve stayed pretty steady, okay, at about $1 trillion for a long period of time. And guess what this is? 2008. And all of a sudden, the Federal Reserve injects a bunch of money into the system. They buy bonds. So the balance sheet of the Federal Reserve explodes from 2008 to 2015, where they purchased a large amount of bonds in order to inject money into the system. And this drove stock prices back up, and it drove multiples back up. Interest rates went down, and multiples went up. And so where we are today, this is 2015, where we are today is we're starting to come back down. But we've got a long way to go. All these excess assets need to be unwound or sold off the Federal Reserve balance sheet. But the explosion in the money supply explains why the stock market has had such a big run since the bottom in 2008. Okay? Also, we had a very nice rebound. This is earnings growth. This is a chart of earnings. Okay? And so you can see where earnings bottomed in 1980 and went on a very, very long run. Okay? All the way up to where we are today. So we're still at the historically very high levels of earnings. So easy money, really nice growth in earnings leads to good stock market. Then we had investor sentiment. This is investor psychology, optimism. Okay? Above the line is positive, below the line is negative, and you can see going into the presidential election that investor sentiment was actually very negative below the line, which doesn't happen that often. Okay? So going into Hillary versus Trump, things were negative, and investor sentiment has really turned around. Okay? So these affect multiples in a big way. Easy money, interest rates, the growth rates of earnings, and investor sentiment. Let's see what investor sentiment would look like. Yeah, this is during the recession. All right. Okay, you cannot separate the multiples and interest rates, multiples and inflation. And this was a mistake that Alan Greenspan, who was chairman of the Federal Reserve, considered to be one of the greatest Federal Reserve chairmen in the history of our country. He told us back in 1995 that the market was overvalued. And after he said that, he looked at PE ratios, and he said P ratios are too high. After he said that, the market went up 20% that year. The year after that, it went up 20% again. The year after that, it went up 20% a year, 20% again. 3 years in a row, after the chairman of the Federal Reserve cautioned that the market was overvalued. How did he miss it so badly? He made a very basic mistake. He forgot about inflation and interest rates. And so what this shows us is that when inflation is less than 3.5%, the S&P 500 averages over 16 times. When inflation is greater than 7.5%, it averages about less than 9. So the higher inflation is, the lower multiples are. That's what this table shows us. And inflation went to 0, people. And interest rates went to 0. And so interest rates went down and the multiple went up. Here's another way of looking at this. When long-term interest rates were moving up, the PE ratio of the S&P 500 was at 12.8. When interest rates were moving down, the S&P 500 averaged 17.5. What is the average for the last 150 years? 15.5 times. Where are we today? We're about 18 to 19. But interest rates are still very low. Okay? The point is that when rates are moving up, multiples move down. When rates are moving down, multiples move up. Okay, so we can't just look at multiples. We have to look at inflation and interest rates. All right, let's use history, the history of the markets, to see where we are and where we are likely to go. We can chart these things. So this chart shows us economic cycles. And what we see here, we're way over here. We are still in an uptrend. So far, when this was taken, it was the 5th longest bull market economy run. It's longer than that now. So this shows us how long each of the economic cycles ran. And so we can see that we had a long cycle in the mid-90s, from the mid-90s and up until the late 90s. And now we are here, and you can see that the cycles were pretty short in here, and then beginning, and I think that this looks like 1945, the cycles started getting longer and longer, okay? So where are we today? We're somewhere up in here. So the point is, the longer our cycles go, you can see whether we're likely to maintain the cycle or whether things are getting late, if we're late in the cycle. And so we're way up here now. We're late in the cycle. Chances are we're going to have a recession in the next couple of years. All right, this is a chart of how long it takes to go from the bottom of a market, stock market, to the top. Okay, and then what happens after you reach the top? You go back down. So what this shows is the average or median time it takes, which is the length of time of a bull market, about 4 years. About 4 years. So when this chart was taken through 2015, we've been up for 6 years. Well, now we've been up for 8 years, going on 9 years. Okay, so there's been only one other bull market since 1932 that lasted longer than 9 years, and that was in the 1990s. So history tells us, once again, we are late in the game. We can use history to show where we are in the cycle. And then lastly, what this chart shows us, these lines, these blue lines and gray lines in here, show us bear markets, a 10% plus drop in the market. And going back to 1985, from 1985 and earlier, you can see that we have many more corrections. That corrections have really slowed since 1985. We don't have as many of them, and they don't last as long. We had one big 2-year correction from 2001 to 2003, and then we had 2008, 2009. but we haven't had as many corrections, and they don't last as long. And our bull markets in the last couple of decades have lasted a longer period of time. So that's what these charts show us. One of the good things about these charts is they show us that it doesn't take long for markets to recover. All right, so this chart shows the length of the bull market and how far the market ran. So back in the 50s, we had a 407% increase in the market, and it lasted 91 months. Then we had, this is a 19-month, 60% increase in the market. This is a 14-month, 39% increase. This is in the early 60s. Then the 60s, from 62 to 65, we had a 90% increase in the market. It lasted 43 months. And then, once again, here we have a long 61 months, that's 5 years, bull market in the early to mid-70s. And then we had the great bull market of the 90s, where we had a 526% increase that lasted 118 months. It went from the middle of 1990 all the way until 2000. So we had a very long, very powerful run-up in the market. And then we've had 3 short blips since then, and we've been positive really since 2010. So this gives you an idea of a historical understanding of bull markets and also bear markets. So here are the bear markets down here. 15% decline, 17 months. 8% decline, 15 months. 22% decline, 6 months. 16, 29%. These all last short periods of time, between 6 months and 20 months. Okay? 43% decline. But most of the declines are in the mid to high teens, and they only last for less than a year. Now, we had this big decline in 2000, 2002, it was a 43% decline that lasted 30 months, and then we had this 51% decline that lasted, I can't tell, 16 months. So we had a 30-month decline and a 16-month decline here. And when the markets are like a rubber band. The farther you stretch them, the harder they snap back. Okay? So all these charts give us an idea, okay, of how the market has traded over time. All right, so what conclusions can we come to? To assess the stock market, you have to consider several variables. The U.S. economy and the U.S. stock market have grown significantly over time. That's the good news. The economic and stock market data is volatile. That's scary news. Okay? But it is positive. The economy and the stock market positive 70% of the time. Bull markets and economies have begun lasting longer and are significantly larger than corrections and recessions. Do not let corrections and recessions scare you. 10% corrections in the market are very normal. They happen about every 18 months or so. We've gone a few years without one. It typically takes between 25 and 110 days for the market to recover from a correction of between 10 and 20%. So it takes 3 to 4 months for the market to recover. That's not too bad. 5% corrections happen every 3 to 5 months. These statistics are very important. You need to know and understand these statistics so that you can share them with other people so that people don't make mistakes with their investments. Okay? Although the average annual return for the stock market is 10%, the market rarely generates an annual rate of return of 10%. A return of 0 to 10% historically only happens about 24% of the time. So when you use that average rate of return of 10%, please understand that it only happens, a return of 0 to 10%, only happens 24% of the time. So this is important data for you to understand about the market so you can share with your clients, you can share with people you care about to keep them calm and make them aware of how the markets operate, and so you can plan and manage investments with this information, this helpful information in the forefront of your mind. Okay, I hope you've enjoyed this data, these statistics. And oh, I'm sorry, I have a little bit of investment advice on here. I was getting ready to cut it to end our time together on this clip, but let's go ahead and go over some investment advice. First, don't listen to too much news, okay? There's a lot of meaningless noise, and it could scare you. And I get calls from scared clients all the time. Don't panic when the market declines, okay? Because declines, as you just noted, declines are frequent and they are short-lived, okay? Don't try to time the market, okay? That means trying to pick perfect times to buy and sell. Don't do it, okay? Use market volatility to fine-tune your portfolio, but don't make major changes in your portfolio, okay? Diversify, very important. Dollar cost average. Put money in over time on a regular schedule. Buy in, it's called dollar cost averaging, okay? Consider investing in indexes rather than in individual securities so you can get that diversification and dampen your volatility, okay? Let's see what else I have to say. Guess what? The average investor earns 2% per year instead of 7% because he or she does not follow the advice above. So that's really powerful stuff. Statistics show the average investor earns 2%, while the markets earn a balanced portfolio around 7%. Why is this? Because of the mistakes that investors make. They get emotional and they make mistakes. Let's not let that happen to you or anybody you care about. All right. See you in chapter 11. Peace. Shalom.